Let's get in our conversation this morning with Dinshaw Irani, Helios Capital Management. Dinshaw, always a pleasure to have you on the show and great to have you on today as well. I mean, we seem to be a market looking for a direction right now. How are you looking at the opportunity?
Well, thank you for having me on your show, and a very good morning to you, your team, and the viewers. Our feel is that the market, actually, I mean, if you look at what the market has done year to date, the NSE 500, I believe, is up some 20 odd percent as such. We don't see that repeating. I mean, next year, the next calendar year, that is, we don't see that happening because we think there's enough pressure on pockets within large caps, mid caps, and small caps also, which may not make you see that kind of return. We're looking at probably around mid-single digit kind of returns, and that's the best case scenario we're talking about. And this all stems from the fact that one, consumption has taken a tank and has got deteriorated. In fact, our belief was that probably the September quarter will be the bottom, and you'll see a trough in December and then probably a pickup. But looking at the advanced numbers of some of the consumer companies which have declared them, I think it was only Godrej Consumer would declare it, and India specific numbers that they came up with. Looks like we've yet not hit the bottom. Maybe, again, the best case scenario today looks like December hitting the bottom, trough in March, and then probably a pickup from June. And that also will be based on what the RBI does. The hope is that they will start looking at interest rate cuts from Feb onward, so maybe there'll be uptick there. So that's one of the major reasons. And the second major reason is obviously the biggest economy in the world having a new head in place. What will be his way of looking at trade? And as of now, it's like pure tariff war that he's talking about. So obviously, one has to look out for that also, and then take a call going forward as such. And also, let me put a caveat out here, the numbers that we're talking about, I mean, as in the mid-single digit kind of growth that we're talking about, will more or less be back-ended. Maybe in the second half of the year. The first year will be a flat market in a best case scenario.
You know, Dinshaw, it's almost like you're setting up expectations or managing expectations because now for a lot of investors, and not just in mutual funds, and you know, of course, you're looking at that world as well, but investors overall, this is becoming a time of slow growth, low growth, that not many are used to, not many participants in the market are used to right now. So are you managing those expectations? And are you seeing a pickup maybe post-budget 2025?
Yeah, actually, a lot will depend on it. Normally, a budget is supposed to be a non-event, but given that the budget which was presented in July was actually a dampener for the market. I mean, our belief was it was a fairly negative budget, not only because of the capital gains tax which was imposed or increased rather, but also for the fact that they cut off on the capexes. And I think the government has course corrected. Actually, our feel was that they had done a drastic correction by not sticking to the initial bit of 5.1% as fiscal deficit and reducing it to 4.9. And in the bargain, they were taking off quite a bit of capex on railways and defense. I think from October onwards, I mean, the numbers will come out later, but obviously, I think the shake-up call was probably the GDP numbers for the September quarter, which saw a fair bit of dip in terms of growth rates. I think from October onwards, looking at the balances with the RBI, the government balances with the RBI, which are running really low, our belief is that now the government starts spending. I mean, I think they were waiting for the private sector to kick in, spend to kick in, but never happened. And as a result, they had to come in a big way. So again, these things don't happen overnight, right? I mean, the trickle-down effect to the consumption space will probably work out in the next couple of quarters. Again, ties in with the trough being hit in the March quarter and probably a pickup from June quarter onwards. So that's what the thing is. I'm not trying to manage expectations, but I believe that this is actually what's going to happen going forward. And yeah, as you rightly mentioned, I mean, I think some 80 or 90% of the investors today in the market haven't seen a bear run, and hopefully they won't, but at least they haven't seen a market where they're getting zero returns also. So I think that is to be managed a bit.
It's also Samina joining in. Your funds have done exceptionally well in the calendar year gone behind us. managing expectations hence becomes even tougher, right? As we go into a new year with a lot more uncertainty and the fact that the mother market is, pulling funds back out of emerging markets, what are you doing with the markets right now? What are you doing with your portfolio? Are you rebalancing? Are you taking profits off the table? Are you adding incremental capital? If yes, are you doing it over a period of time? That period of time is 3 months, 6 months. Tell me the strategy.
So, Samina, thank you for asking me that question because we really don't believe in keeping any cash in the portfolio. I mean, we always believe that there's enough and more in the market opportunities. If you're missing out on keeping cash is basically you're not taking a call in the market, right? You're just trying to say that, look, I want to be on the safe side and keeping so much cash with me. But our belief is that there's enough in the markets to work with, and that's why you'll see that quite a bit of churning has happened in our portfolio. I mean, we've obviously been looking at safety first for the investors as such, and as a result, what we've done is we've increased our exposure to financials, and that comes from the fact that not only do financials do well in a growing economy, they do phenomenally well going forward, right? And not only the banks part, the lenders part, but also the non-lenders part. And that's why our exposure to these two segments, I mean, lenders and non-lenders, have gone up quite appreciably. That's one area. IT has been another area where we've been very bullish from July onwards, in fact, this year. And that we've only strengthened our position in that, adding to IT on a constant basis. The new tech companies, our belief was, I mean, our belief is rather that they're going to do very well. But the fact is that the valuations look fairly, I mean, I won't say stretched, but fairly on an expensive side today. And basically, we may just look at holding back there. I don't think we want to add more on the new age companies as such, but we're very happy with the way they performed. We think going forward also they do very well. But the fact is that more sound bites are coming in that industry. So maybe you want to take a breather out there rather than keep adding to that side of the portfolio. And obviously on the affluent consumption space, I think we've done fairly well there. I mean, look at the hotel stocks; they've done phenomenally well for us. I think this is one space which will keep doing well. Economy which is becoming richer, the rich will keep spending more on these kind of spends as such. And looking at domestic tourism, which is yet to pick up, I think that's another area. So you keep shifting between these kind of factors as such, and you keep taking a call that I want to do this rather than keep unproductive cash with me. I would rather have some productivity on my returns as such. So.
Sure. I know this is a bottom-up approach and there are a few sectors that you've liked, and I think you've maintained the view on that, right? Travel, for example. But what I find a little perplexing is that we've been talking about this extensively of how the risk reward has been favorable in the large cap space more than it has been in the broader markets, which you would also agree with me, right? But invariably, every time there's a market recovery, it is the mid-cap space that begins to outperform the benchmark, which is the most expensive part of the market. The large and small cap space still offers some value, but it's only the mid-cap space that sees action. How does one deal with this, right? And I ask you this because you understand the market, and I know investors are building portfolios. So if you're building portfolio, where should your bias be? Do you go with momentum? Do you go with value in some ways?
So basically, it's a call that you need to take, right? Normally, there's a time for everything. In fact, what we say that whenever some investors ask us that, do you go for value or growth? We say, look, we try to buy growth at a value. That's how we want to position ourselves rather than getting fixated with one particular form of investing, right? So that's what helps us in a way in terms of changing our portfolio as and when we like it to be. Having said that, look at it this way, Aisha, that the problem is that the market is looking overvalued in pockets. I mean, even in mid caps, there are certain stocks which are P's of 80, 90 forward earnings. Those are definitely avoidable, given the fact that the earnings growth is not even commensurate, forget commensurate, even a fraction of those kind of PEs as such, yeah? So that's why you avoid those kind of stocks per se. There are actually, we did our own study and we realized that there are some 120 odd stocks in the NSE 500. By the way, NSE 500 is roughly around 90-95% of the overall market cap of India, all the stocks in the 500 index as such. account for almost 90-95% of the market cap of India. If you look at around 100-120 odd stocks, they still quoted P's of 19 times forward earnings. So it's obvious that you have to now look at these, and there's a healthy mix of all three. I mean, there's not only large caps, obviously a substantial chunk is large caps, but a healthy portion is there of mid caps and obviously small caps also. So you always have ideas to look at, and you always have to pick out those. Having said that, you're right, the momentum normally comes in only the momentum stocks which are on a way up, but we've seen that in the past. I mean, these are passing fads, and once reality hits, and you've already seen that in a couple of stocks, right? The ones which are quoting at P's of 100 odd didn't, I mean, disappointed rather in the September numbers, and the stocks came off. And again, they picked up, but I'm sure December quarter will be another revelation for these guys. But yeah, that's what you keep doing.
Dinshaw, I'm just wondering, what are you excited about right now? Because you're absolutely right. We've come off, but then the pockets which are looking good are still high in valuation. What is exciting you right now when you're looking out for new opportunities, or is the strategy just to be slow and steady? What is you know, sort of your big winners for 2025 that you've identified?
So the big winners, I won't call them big winners, I would call them rather safe bets right now for 25 would be basically, as I said, the financials, and mainly in financials, the services part. Because again, I mean, we actually have a fund which is financial services fund, and that's run fairly well in its brief history of 6-7 months, and that's mainly because it's heavy on the services part rather than on the financial, on the lenders part per se. Even in that, I mean, as I said, the lenders part, we've been very cautious. We've been cautious in the sense that we've always looked at the asset quality as a big indicator of what a bank can do when the markets are turning around, rather going down or going up, right? So that's why we've been very careful in that. We've been very selective in that. We've avoided all the banks which are disappointed during the COVID times, and that's proved perfect. I mean, you've seen the results in September. There were banks which did very well during the results season, and there were ones which fell out 20% odd. Mostly the microfinance ones which had exposure to microfinance. I think that area is a definite no-no for us. Even the NBFC space, again, on the lending side, we've been very cautious here. We've not touched any NBFCs. We've been only there in, I think, two of them. And that also mainly because they were CV financiers. And we're very comfortable with CVs as the commercial vehicles I'm talking about. And that's what we stuck to. In the non-lending space, it's mainly the market-driven forces. I mean, as in the ones which are exposed to what happens in our equity markets, be it the exchanges or the depositories or the RTAs or even the AMC companies or the wealth managers, basically the gatekeepers to wealth, if you will. I mean, this is what we've been looking at on the non-lending side. In the IT space, again, as I said, that we're very comfortable. We've been upping our, the weight in IT on a constant basis, and we keep doing so. I think that again stems from the fact that in US, though Trump is coming in and people say that he will impose certain things on the IT space, but look at the unemployment in the IT space. It's in low single digits or something. I mean, it's in fractions, less than 1% or something. That's what I was told. So there's no way they can do anything further there. Manpower is a big source there, right? Manpower is the big raw material for them. So it's obvious that IT will continue to do well, given that US is doing well. So that's where we keep increasing our exposure. And as I said, that obviously consumption space, again, we've been very careful. We've only been in the mass affluent consumption space, and that's done very well for us. Tourism is one of them. The new age companies where we continue to remain quite exposed in terms of the weightages as such. And that, I believe, platform companies should do well going forward also.
The upside has already come, Dinshaw. I mean, some of the ideas that, we've been talking about this morning for 2025, real estate among them, some steel companies as well, CDMO. Are you looking at any of those with interest or any, top bets there?
So in the pharma space, we are quite comfortable with the CDMO space. We've got a couple of companies there. We're not looking at carpet bombing within pharma, because pharma actually, I mean, US, looking at what Trump has been all along saying about Obamacare, it's obvious there will be some changes happening out there. So it's better to stay away from the companies that are exposed to the US in terms of the generic space there. Better to look at the CDMO space and the domestic facing companies. This is what we're doing. In the metal space, I think one has still not seen what China can do, right? I mean, last year, China, by the way, China's capacity in steel alone is equal to the world put together. So you can imagine what kind of clout he can drive in the market. Last year alone, they exported some 9% of the capacity outside, and that 9% was equal to US and Japan's capacity put together. That's the kind of export that they did. So it's obvious that if China doesn't do well, which I don't think is happening. I mean, the economy is suffering right now. So I don't see. I think they'll be more of driven by exports than anything else. If that happens, metals will not do too well for us. I mean, I don't think 25 is a year you want to be exposed to metals or any other commodities which are being driven by China. So that's why the bets are fairly limited. And as I said, safety first.
Thank you. Thank you. This was great. We'll hopefully see you soon. But if we don't have a great end to a pretty profitable year that'll be behind us, and hopefully 2025 is as profitable as the one that we leave behind soon. The markets...
Fingers crossed.
Yeah, fingers crossed. I do think we've borrowed returns in the future, but yes, there's no harm being optimistic. So it's the hope that keeps the world going around.
I guess so.
But have a good time. Thank you, Dinshaw.